Okay, the next section is keys to understanding real estate finance. Okay? Economic theory for 200. Borrow to maximum. What's the definition of borrowing to the maximum?
Leverage.
Leverage. Leverage. What is leverage? The definition of leverage is using other people's money and making a profit on it. If I buy a house for 100 grand and get 100% financing, and in a year it's worth 110,000, zero of my own money made $10,000. That's being fully leveraged. If, however, I put 10% down or put $10,000 down and made the same amount of money, my $10,000 made $10,000.
So you stay with the same.
400. Who benefits from appreciation?
The trustor.
The trustor. I benefit from appreciation. When you guys appreciate me, I really like it. But that's not on the state exam, okay?
Are you sure?
The trustor. Your real estate class instructor / whatever loves her appreciation.
We can put that in notes.
Trustor. When a property values increase, this benefits the borrower or the trustor. And remember, the lender's basic protection in any loan is always the borrower's equity. Remember these three things too. How do we get equity? One is you can put a large down payment on the house, and that's equity. Two is you can negotiate a great price on the house, and it could appraise for higher than the amount that you offered, and you have equity the day you walk into the property. And three is you could have been 100% leveraged, like on that example before, and then over time the price of the house increases, and you have equity then. So
what was supposed to write down?
whatever you want out of that.
Oh, I didn't.
Truster.
Borrower, a trustor is the one who benefits from appreciation. But the ways, there's three ways to get appreciation. One is for being a really good real estate school instructor. No, I'm sorry, I made a mistake. One is from putting a large down payment down on the house. Two is from negotiating a great price where the appraisal comes in higher. Three is just over time getting appreciation house. The reality of it is though, the more money the buyer, the more of the buyer's money that's invested in the house, the less likely they are to default on the loan.
So appreciation is like the equity.
Yes.
Okay.
What was the third thing she just said? That was leverage.
600, home sales increase. What happens when home sales increase?
The
The
value of
economy's
money.
thriving. The gross national product, GNP, jobs and income increase.
Sorry.
That's a lot to write down. So GNP, jobs and income increase, that means the economy is thriving, and so home sales increase at the same time. When the economy is thriving, the housing market also thrives. When prices decrease for 800,
Money increases.
the value of money increases. If prices drop 20%, then a dollar can now buy $1.20. You can afford a bigger home for the same amount of money. He said, move my head.
Please.
Lenders for 200. Who makes large loans?
Insurance companies.
Insurance companies. Insurance companies specialize in large commercial properties and better class properties. It's cheaper to service $1 billion loan than thousands of $100,000 loans. They also make a percentage of the profits doing a participation loan. So you remember that like insurance companies are the ones who make those loans like for Staples Centers and big huge projects like that, okay? 400, who sells in the secondary market?
Mortgage companies.
Mortgage companies. Mortgage companies are like the middleman. They match a lender with a borrower and they warehouse loans, which means they collect loans and sell them in the secondary market. They are active in construction lending and interim loans. Remember that a construction loan is a synonym for an interim loan. They might use either or when they're talking about construction loans, okay?
Is a synonym for what?
Interim loan.
Interim loan.
It's the last sentence.
For 600, who's the primary source of home loans?
Credit unions.
Credit unions and mortgage companies. Credit unions account for a large share of home loans together with banks and mortgage companies. Since they are not for profit, they operate on a small profit margin and offer lower rates than banks. For 800, who regulates the flow of money?
The feds.
The Fed. The Fed operates as the banker's bank. They may borrow money from it or sell loans to it. The Fed controls the flow of money by raising or lowering interest rates. Raising rates creates a tight money market, or changing the amount of reserves each bank needs to maintain in order to control how much money is available for lending. So if they raise the amount of reserves, if they raise interest rates, they're creating a tight money market. When they sell bonds, they're creating a tight money market. They want less money out to be loaned. The money held by the Fed is created by the selling and purchasing of bonds. So obviously when they lower those things, they make a looser money market, right? Practices for 200, who maintains the secondary market? Freddie Mac. Freddie Mac was created to maintain a nationwide secondary market for conventional loans. Mac ends in C for conventional. It's like a little way I remember Freddie Mac, conventional. 400, not a demand source of money. Fannie Mae, FHA, right? Fannie Mae was created to provide a secondary market for FHA loans. Remember, FHA doesn't lend money, they insure loans. So the reason Fannie Mae is not a demand source of money is because FHA isn't a demand source of money. FHA doesn't give money, they insure the money that's given, right? You don't have to go to the office of the FHA or anything like that. You literally go to a regular federally regulated lender and they can get you an FHA loan, okay? What shows the monthly payment for 600?
Immunization table?
Yep, the amortization table. It's the definition of what the amortization table is. Practices for 800, the result of the income plus the borrower plus the property. The result of the income plus the borrower plus the property is what? Loan commitment. The lender looks at the creditworthiness of the borrower, the income of the borrower, and the appraised value of the property in order to commit itself to the loan. They have to do all three, right? They want to make sure that the borrower is worthy and they have a job, that they have, good FICO score, and that the property qualifies for the loan, that it appraises at a certain value. Oh, shoot. Truth in lending for 200. What is the purpose of the truth in lending statement?
Meaningful disclosure.
Meaningful disclosure. For truth in lending, RESPA, Regulation Z, they might use any one of these kind of interchangeable. So Regulation Z, RESPA, RESP, oh no, not respect. RESPA. And truth in lending is all about meaningful disclosure, right? It means it's telling the buyer, like, what's it really going to cost, right? When you get a $100,000 loan and pay it over 30 years, how much are you really paying for the house?
A lot more.
About 3 times the amount, $300,000. So you need to understand that when you're buying a house that you're paying to borrow the money, right? You're paying fees to do this. And so RESPA is all about meaningful disclosure so that the buyer can go and look at what you have to offer and what you have to offer and then make a decision. Do I want to go with this person? Do I want to go with this person? Or am I not doing this at all? Okay? 400, it's not necessary. The truth in lending is not necessary for what?
Agriculture.
Agricultural. It's a weird question and it's kind of like a not kind of thing on the test usually. It's not necessary for agricultural. For 600, what is the cost of credit shown as?
APR.
APR, the annual percentage rate, includes the cost of the credit, including fees to purchase the home. It is so a purchaser can compare apples to apples. A lot of banks will say, oh, my interest rate is like 5.1, and another bank might say my interest rate is 5.5. What you want to do is compare APR to APR. The 5.5 might have 0 points, and their APR might be 5.52. And the 5.1 interest rate might be a 5.785 APR, because it's costing money to give you the 5.1. So when your clients are like out there, you want to make sure that they're looking at the annual percentage rate and not just what the interest rate is. Because there's a cost to getting that loan. How much can the bank charge for the uniform settlement statement?
Zero.
Zero. The uniform settlement statement shows like how much you're actually going to pay for everything, and they can't charge a fee to show you what you're going to pay for everything. Types of loans for 200. What protects the lender against default?
FHA.
FHA, mortgage insurance. Mortgage insurance, PMI, private mortgage insurance premium, those are all different words for mortgage insurance. They all protect a lender against default. FHA insures loans You don't need to go to the